Many successful private companies these days choose to remain private and defer their initial public offering for a fairly significant period of time. It once used to be the standard that successful private companies would pursue an IPO, which was then thought of as the ultimate liquidity event or the gold standard within 5 to 7 years of having been founded. That time horizon is now more like 7 to 11 years. And during that period of time, companies conduct successive private placements. Through those private placements, as well as through the issuance of stock options or other stock-based compensation to employees, companies, even privately held companies, may end up having a fairly dispersed stockholder base. Even before the Jobs Act, it was a concern for many private companies that they might default into Exchange Act reporting obligations. A company can become subject to Exchange Act reporting requirements if it volitionally chooses to undertake a public offering and offer its securities pursuant to the Securities Act of 1933, if it chooses to list a class of equity or debt securities on a national securities exchange, either in conjunction with an IPO or a capital raise, or on its own in a direct listing, or if the company exceeds certain specified 12G thresholds. Pursuant to the Jobs Act, the 12G threshold was modified to allow companies to remain private for a longer period of time. As a result, if on the last day of its most recent fiscal year, an issuer has total assets that exceed $10 million and also has a class of equity securities that's held of record by greater than 2,000 persons or by 500 persons who are not accredited investors, it becomes subject to Exchange Act reporting requirements. Helpfully, option holders that receive their securities pursuant to a written compensation plan or pursuant to issuances made under Rule 701 are not subject to or can be excluded from the held of record threshold. As a result, many private companies are allowed to remain private longer. Nonetheless, private companies may choose to impose ownership or transfer restrictions for a number of reasons: to monitor the number of holders, as well as to be able to identify their holders. Ownership limitations and transfer restrictions can be imposed under a company's certificate of incorporation or through contractual provisions. For many private companies, it's pretty customary for the issuer to have a right of first refusal to repurchase securities if an investor seeks to sell shares. Likewise, many companies impose certain fees or requirements to obtain legal opinions in connection with the transfer of securities. These measures are very important for private companies, particularly as companies remain private longer. In addition, for many private companies these days with dispersed ownership, it becomes an important measure to impose insider trading policies. That may seem a little unusual for a company that doesn't have a class of securities that's listed or traded on a stock exchange. However, as I noted, stockholders have become more dispersed, and many companies will have a private secondary market for their securities or may even sponsor a liquidity program for holders of their securities in order to allow them the ability to monetize a percentage of their holdings. It's important that holders that have an ability to sell their shares pursuant to a secondary liquidity program have certain information made available to them, but also that sales are prohibited during particular periods of time. A private company also might choose to impose certain communications policies to ensure that it can monitor the types of information that become public about the company, the timing of the release of that information, and also control who speaks on the company's behalf. We're living in a new world with private companies that are larger than anybody had foreseen, with more dispersed ownership, and with name brands that are as well known, if not more well known, than those of many public companies with securities that trade on an exchange. Therefore, it's important for private companies to think about corporate governance and other safeguards that may, once upon a time, have only been appropriate for SEC reporting companies.